Good afternoon, everyone. Welcome to our session on Carmignac portfolio grandchildren. This is a global equity fund, and as the name implies, it has a very long-term investment horizon. I'm the manager of the fund, and if I was to describe the fund in one sentence, I would say it's a bottom-up fund investing in high-quality companies for the long term. And then you're all thinking, that's what everyone says. Everyone says exactly the same thing. What's different about you? And anyway, what does quality mean? Who invests in poor quality stocks? Well, all of that is true, but what I'd say is we have a very specific definition of what we mean by quality. It's based on historic accounting data, so it's objective. It's not my opinion or your opinion, it's a fact. We also have a macroeconomic overlay, and as well as integrating ESG, this is a sustainable fund. It's an Article 9 fund with 100% alignment with the United Nations Sustainable Development Goals. So those are the three differentiating factors, but for the purposes of a 15-minute presentation, I'm just going to focus on one of them, and that's quality. What do we mean by quality? Why is it important? And it's going to lead to a discussion around reinvestment, which is an important theme for the companies that we invest in. But first of all, let's take a look at quality. And on the slide there, you can see one definition of different investment styles, according to MSCI, quality, growth, and value over about 40 years. And you can see, of course, that quality, my pointer isn't working, so the quality is the pink line, and it's performed very well over a long period of time. So it makes sense to use that in some sense as a backbone of one's investment approach. But the other feature that you'll notice, especially obviously in 2022 there, but also in year 2000 and in 2008, it's an investment style that from over a short period of time can have large drawdowns. But that makes it ideally suited to the grandchildren fund. It's delivering the best returns over the very long term, which is what we're interested in. And because we're focused exclusively on that very long-term investment horizon, of course we don't like the drawdowns, but we're prepared to ride them out and accept them as part of investing in the best strategy for the very long term. The second question is, how does this happen? Now, quality stocks are usually associated with high profitability, stable profitability, good free cash generation, good balance sheets. And all of those things are reflected in this definition that they're using here. Is it the case that over time, these companies just become progressively more and more expensive? They start on 10 times, then 20 times earnings, then 30 and 40 and so on? No. Over the very long term, there's no, the key driver of this outperformance isn't a re-rating, it's superior earnings growth. These companies have better compounding earnings growth, and that is by far the largest contribution to this superior performance. So for us, how are we going to identify those companies that, going forward, have that superior earnings compounding power? And we have a very simple definition, and that's that companies with the best long-term prospects in terms of that earnings power can demonstrate today two key characteristics. The first one is they can demonstrate historically that they've been able to sustain a high level of return on capital above a hurdle rate or above an average rate. And the second one is that they reinvest a high proportion of their cash flow in growing the business for the future. So the concept being that any business today can be expressed as an amount of capital employed. The companies we're focusing on, the first characteristic means they're earning a return on capital above a hurdle rate. They're creating value on that fixed capital base. But by reinvesting the cash flows they're generating and expanding that capital base while preserving that profitability spread, you get a compounding effect in the intrinsic value of the business over time. Okay, well, what evidence do I have to support that? Well, if you look at this slide, what we've done here is we've shown in the dark line is the performance over the past 15 years or so of the MSCI World Index. The gray line are high-quality companies, but with a low level of reinvestment. So they have high profitability, stable profitability, all that good stuff, but they reinvest a below-average amount of their profits back in the business. And then the green line are the high-quality companies that reinvest a higher proportion or above average. And you can see the results. Now, this amplifies not only the performance of high-quality stocks, the reinvestment, but also the volatility. So again, for some people, that might be off-putting, that level of volatility, but of course, for the grandchildren fund, where we're focused on the very long term, we're prepared to ride out these periods of performance. Now, so far, all I've talked about is the concept, profitability and reinvestment. In reality, when we're managing the fund, we have a screen, we have a process, a quantification process, where we quantify. We have a recipe of different measures of profitability. We rank them. We come up with a composite scoring system. But again, for the purposes of a brief discussion, this isn't really the place for that. But suffice to say, I've been using this approach now in European equities for 20 years, and in global equities since we launched this fund 4.5 years ago successfully. Now, the other point here is that this isn't a quant fund. Yes, we use a filter and we use a focus, but it's a stock-picking fund as well. We only have 40 stocks in the fund. And it's a high-conviction fund. You know, we have individual stock positions, 6, 7, 8, 1, even 9% of the fund. So we're also seeking to add alpha through stock picking over and above this tailwind that profitability and reinvestment should give us. So I want to look at some of the stocks now, and I want to call out this theme and examine how this theme of reinvestment has affected these companies. Reinvestment can take many forms. It could be a successful retail format rolling out new stores. It could be a manufacturing company investing in new factories. It could be a company expanding through mergers and acquisitions. And then I have 3 examples of different types of reinvestment, which we're going to talk about. I do warn you that we're investing for the long term in high-quality companies. Many of the companies we focus on are well-known businesses. They are hiding in plain sight. They're often commonly held in other people's funds. They may have performed well, but we still think because of these metrics, they're going to continue to perform well. So with that warning in mind, let's turn to Novo Nordisk. No discussion of a global equity fund these days will be complete without talking about obesity and the GLP-1 drugs that Novo Nordisk and Eli Lilly have been successfully exploiting. It's well known, it's a well-held stock. Novo Nordisk stock price is up 35% year to date. Eli Lilly up, I think, 60% year to date, reflecting the fact that this concept is well understood. However, we think there's much more to go for, which I'll come on to. But how does this business fit within the lens of profitability and reinvestment? Well, Novo Nordisk established itself decades ago and built its reputation manufacturing insulin to treat type 2 diabetes. It's a very profitable business, almost 40% operating margin, so we can tick the profitability box. But this company also reinvests a significant amount in R&D, research and development. And almost a decade ago, they developed a new category of drugs, the so-called GLP-1 drugs, which we see today in the likes of Ozempic, the well-known brand to treating diabetes. And more recently, that molecule has been approved for the even bigger epidemic of obesity. So definitely capturing the profitability and reinvestment theme. Why do we think there's more to go for? Well, if we before we even get onto obesity, let's talk about diabetes. Ozempic was approved in the US about 6 years ago, so it's been around for a long time, but prescription growth of that drug in the US is still growing something like 60% year on year. What's happening is that the GLP-1 category of drugs is taking volume market share of the treatment of diabetes from other inferior products. The current volume penetration of GLP-1 in diabetes is about 12% or so. Speaking to the managements of Novo, Lilly, and other companies, they expect that penetration to grow perhaps to 20 or even 30% of the volume of treating diabetes. So there's many more years, hopefully, of growth just in diabetes. And that's before we even talk about obesity, which is an even bigger epidemic. The issue they've faced with obesity is that they haven't been able to manufacture enough of the drug to satisfy the demand. Both companies, Novo and Eli Lilly, completely underestimated the skyrocketing demand for Wegovy and the Lilly equivalent. However, over the the next 2 years or so, we should see manufacturing capacity go up 3- or 4-fold to enable the company to satisfy demand. So when I look at near-term estimates of profit growth, this is a company that's growing its profits this year between 40% to 45%. We think that level is going to continue, and the current estimates of about 20% for the next 3 years are too low. So we'll see continued upgrades there, which means we still maintain a high exposure here to this name and to Eli Lilly. And by the way, we're high conviction. So between the two names, we have about 15% of our fund exposed to this theme. But we don't just invest in, racy, high-velocity names. We sometimes go for more steady Eddie businesses. And here, one example is Procter & Gamble, the consumer staples company, the leading player in personal care, baby care, home care, and other domestic consumer categories. And this is a business where the theme of reinvestment is in innovation and marketing, constantly innovating, especially in marketing, to preserve the desirability and the relevance of their consumer brands. And that comes through in the fact that the company has more than 25 brands generating sales above $1 billion. Brands like Gillette, Pampers, Olay, and others. And it's that strength of that brand portfolio that's important and sees them through difficult times. We've just been through a period of high inflation. This company not only has been able to leverage off the strength of its brands to improve pricing, but it's also seen off competitors. It's grown its volume share in most of its categories, reflecting again the strength of its brands. So it's improved pricing and improved volume share, which puts it in a good place for when pricing isn't going to be such a lever going forward. And then the final stock example is another well-known name, Microsoft. Again, I said these names are hiding in plain sight. We still think there's a really exciting proposition at Microsoft. But let's look at it through the lens of reinvestment. I mean, the business was established in the 80s, as you know, generating operating system for PCs and computing, as well as adjacent software for the desktop like Excel, Word, which we now see in Office 365. Office 365 is the world's leading software product. It has more than 300 million subscribers worldwide. But in their Q3 results, that product still grew sales 17%. Okay, 7% of that was pricing, but 10% was the number of seats, the number of subscribers to the product. So it's an amazing engine of growth. But not content with being the leader in operating system software and desktop software, the company reinvested in the theme of cloud computing. It's now one of the leading 2 or 3 hyperscalers through its brand Azure. And again, that business is at an even earlier stage of growth, Azure growing 25% plus this year in terms of demand. And then more recently, through its 49% stake in OpenAI, the artificial intelligence leader, it's well placed to be able to leverage off ChatGPT and incorporate that within its Copilot for Office 365, where we expect the rollout of that by the year end. Our channel checks and our key opinion leader calls anticipate a successful uptake there, but we have to wait and see. We're optimistic. And I know, of course, in the press there have been a lot of shenanigans around the personnel at OpenAI and Microsoft, but leaving that to one side, notwithstanding that, we still see this as a great growth opportunity for Microsoft. And again, it's a high conviction position. We don't have a 2 or 3% position in stocks we like. This is a 9% position in our portfolio. So just to summarize, I've only really touched on one of the differentiating factors, and that's that focus on profitability reinvestment, why it's important. I've tried to bring it to life through some of the stock examples. On another occasion, I would talk about the way we manage sustainability, the way we have our SRI filter focusing on United Nations Sustainable Development Goals. And as if that wasn't enough, we have the macroeconomic overlay where we optimize portfolio construction. That's where my co-manager, Obi Ejikemi, comes in, a former equity strategist at Bank of America Merrill Lynch. And we optimize the weightings of stocks within the portfolio depending on where we are in the economic cycle. So we can pull on a lot of levers to deliver performance. We launched the fund 4.5 years ago, and so far, 10.5% per annum since then, not too bad. And that incorporates, by the way, that down trading we saw in the year 2022, where the fund was down significantly, and way ahead of our category, and our category would be Morningstar Global Equity Growth. So with that, I'm going to finish my presentation 1 minute early. So thank you very much for your attention, and enjoy the afternoon. Thank you.